estate enhancement strategy, or something we call EES. How it works is a lot of people in Canada, because we have been told by, banks and accountants to save money in the RSP, we've got some money right now into our RSP accounts. And if we were to take that money out now or wait till later, there's going to be some amount of tax that we're going to have to pay. And whether you're with a bank advisor or an independent advisor like ourselves, our job is to go out there and actually grow your money. But if I double or triple the amount of money that you have in your RSP, what do you think I've actually done to your taxes? Okay. The answer is actually, I've grown the amount of taxes that you have to pay in proportion to how much money I've grown you. So this strategy is really about repositioning dollars so that we can use them in a more tax efficient way. How this strategy works is we're actually going to reposition these into a permanent life insurance policy, the permanent tax shelter we've talked about. And the process is really, we're going to make a gross withdrawal. We're going to pay the taxes today. Now, this might seem counterintuitive, but if I had to ask you the question, if you know anybody that farms, would you rather pay tax on a small bag of seeds, or would you rather pay tax on the entire crop that bag of seeds produces? Most people say I'd rather pay tax on the bag of seeds. And that's really what we're going to do here, is rather than let this get too big, we're going to pay a little bit of taxes now so that we don't have to pay as much tax in the future. And we're going to use the net number that it provides us to buy this insurance policy. And there's 5 major benefits to this. The first one, and I use the word estate lightly because people understand what it means, but the moment that I buy an insurance policy, the amount of money that I'm going to leave to my kids or my family or a charity is substantially bigger. So just making one premium payment leaves the entire estate, or how much money I leave to my family or whoever, it's grown substantially. The second big reason, and we'll talk about it here in a second, is that there is tax-free income from an insurance policy like this. And the neat part is that tax-free income is actually an entire lifetime of money. It will never run out. It constantly grows and compounds on itself. The big fourth one here is I'm actually going to reduce my risk. So if you think about the amount of money that you have in the market right now, it can go up and down on a daily basis. So think about it as kind of like a stove dial. I've got, as of right now, all of my money is here, it's in the market. My risk is at a 10 out of 10. But as I make this withdrawal, pay the taxes and move it, I move my risk to a 9, and then I move my risk to an 8, until sooner or later, my risk is maybe around a 1 or a 2. The odds are is you're never going to get this fully down to 0. There's a lot of safety factors that come into play to make sure that we can continue to fund this for as long as we have to fund it for. But I'm eliminating my risk because in the market, these products can go up and down just like the market does. This product, which is actually what's called a whole life product, is actually a dividend-driven product. What that means is that you're actually invested in the insurance company itself. And at the end of the year, when they do their financials and they have profit, they pay their profit to their shareholders in the form of a dividend. And so you either get a dividend or you don't, you get one or you don't. And so it creates a bit more of a staircase instead of a roller coaster, where as soon as I'm given a dividend, they can never take the money away from me. And so as long as the insurance company is profitable, our policy is profitable. And the fifth and final one that I love about this strategy is it actually takes no dollars out of your pocket. I'm never coming to you and saying, hey, Mr. or Mrs. Client, I need X amount of dollars to pay for the insurance. You already have the money here. It's in a taxable area. All I'm doing is showing you how you can move it over somewhere else that's less taxable and more tax efficient for us, more tax efficient for the estate transfer to our kids or charities. And so it's a very fantastic strategy where if you have a lot of money in the RSP especially, and you want to find out ways to get it out so you can use it more efficiently or pass it on more efficiently, please reach out to us. We'd love to have a conversation.